Hello, this is BookBriefing. Today, the masterpiece we will analyze together is Benjamin Graham's The Intelligent Investor, which has become a historical Bible of value investing and Warren Buffett's ultimate compass. This book is an immortal survival guide showing how one could protect and restore assets amidst the catastrophic financial ruin of the 1929 Great Depression. Today, following the 8-step brief roadmap shown on the first slide, we will learn how to safely apply our assets to the cold market beyond simple theoretical summaries. From the book's philosophy to the mechanics of macroeconomics and concrete portfolio execution rules, we will firmly build the structural framework of mechanical and scientific value investing. Now, let's turn to the next page. The discipline of value investing was born not during a glamorous boom, but amidst the unprecedented catastrophe of the October 1929 Great Depression, triggered by Black Thursday when the Dow Jones crashed by 89%. The author, Benjamin Graham, also suffered severe valuation losses in this hellish market and learned painful lessons. To survive in an unpredictable market, he created rules that completely eliminated emotion, thus becoming the father of value investing. On the other hand, those who speculated with leverage, intoxicated by public mania, met with destruction without exception. Graham declares powerfully, as written on the blackboard, investing is not prediction, but the mathematics of calculation and defense. Graham likened the nature of the market to a business partner named Mr. Market who suffers from manic depressive disorder. This manic depressive partner visits every morning to propose a price. In a state of mania and optimism, he quotes absurdly high prices, offering an opportunity to sell. Conversely, in a state of depression and pessimism, he offers dirt-cheap panic selling prices, giving an opportunity to buy. However, the unchanging intrinsic value of the firm at the center of the seesaw remains unchanged. While the public engages in panic buying and selling swayed by the market's emotions, the intelligent investor does not treat his mood swings as wisdom. We merely view them as business opportunities to buy at bargain prices and exploit his volatility. In the real investment market, the public falls into the trap of timing, trying to guess when to buy. Intoxicated by the dopamine addiction of the order book and second-by-second fluctuations, they succumb to FOMO and buy at the peak. When Mr. Market's depression strikes and stock prices crash, they face forced liquidation due to excessive leverage, leading to ruin. Graham warns that all attempts to predict timing will, without exception, lead to the speculator's ruin. What we must do is discard the illusion of predicting timing and adopt a mechanical strategy of selecting pricing, buying when it is cheap relative to value. The essence and most powerful absolute shield of value investing is the margin of safety. As shown in the formula, it represents the buffer between the intrinsic value and the actual purchase price. Graham acknowledges the limitations of human prediction and suggests setting up an airbag in advance to absorb unexpected bad news in the market. If you can buy a company worth 10,001 for 6,001, the 4,001 buffer will safely defend your principal even if an unexpected recession hits. This is the sole and powerful mathematics in the investment market for preventing permanent capital loss. From a macroeconomic perspective, the most common error made by the public is misreading corporate profits during inflation. The public falls into the illusion that rising prices will increase corporate asset values and cause stock prices to soar. However, the fact proven by Graham is the exact opposite. Rapidly rising prices cause wages and raw material costs to spike, squeezing production costs and shrinking corporate profits, which ultimately leads to a stock price crash. Therefore, blindly going all in on risky assets during inflation is suicidal. Reducing stock weight and securing a solid cash shield is the key to survival. Graham's signature technique, the net liquidation value method, is a formula to secure an extreme margin of safety. The calculation is simple. Calculate the net value by subtracting total liabilities from current assets, and divide it by outstanding shares to get the liquidation value per share. Graham mechanically swept up stocks only when the price was below 67%, or two-thirds, of this net value. This represents a state where even if the company closes tomorrow and liquidates all assets, it returns more cash to shareholders than the purchase price. This mechanical criterion was the weapon that multiplied capital in the ruins of the Great Depression. For the defensive investor who cannot spend much time on the market, Graham provides 7 quantitative filters to mechanically filter out high-quality companies. First, the scale of annual sales over $100 million to prevent bankruptcy. Second, a sound financial position with a current ratio over 200% to control short-term debt. Third, stability with 10 consecutive years of positive earnings. Fourth, a strong dividend record with uninterrupted payments for 20 years. Fifth, a minimum of 33% EPS growth over 10 years. Sixth, a valuation under 15x PER. Finally, a PBR under 1.5x. Companies passing these 7 hurdles are like fortresses that do not collapse even in market recessions. Here are the 2 most famous absolute rules of Benjamin Graham. Rule 1 is never lose money, and Rule 2 is never forget Rule 1. The public ignores this simple truth and pursues high returns, only to face permanent capital loss. Graham advises practicing 2 things simultaneously to avoid losing money: establishing a strict margin of safety for individual stocks, and diversifying across 10 to 30 stocks. When these 2 pillars are firmly combined, a structural defense network that protects the principal of the entire portfolio is completed. From a behavioral economics perspective, our brains easily surrender to greed and fear when the market fluctuates. To prevent this, Graham advises mechanically practicing an asset allocation target of 50% stocks and 50% bonds. If the market surges and stocks exceed 55%, we sell the excess stocks and buy bonds to return to the 50-50 ratio. Conversely, if a crash occurs and stocks drop below 45%, we overcome fear, sell bonds, and buy stocks to restore the balance. Only those who completely sever emotion and control their actions through a mechanical plumbing system will succeed in the end. In the final perspective stage, we compare how value investing has historically evolved. The core target of the teacher, Benjamin Graham, was bargain stocks priced below liquidation value, securing a price margin of safety through net investing. On the other hand, his disciple, Warren Buffett, went beyond this to discover ultra-blue chip companies with economic moats, holding them long-term at reasonable prices. Buffett expanded the margin of safety from current assets to the certainty of future cash flows. Value investing evolved from strict price defense to overwhelming business insight. Today, through the eyes of Benjamin Graham and Warren Buffett, we have obtained an immortal compass to protect ourselves in a volatile market. Let's engrave the 3 principles indicated by this compass. First, own stocks like a business owner, as stock purchase is a business acquisition. Second, do not be swayed by Mr. Market's crazy price tags. Third, profits without a margin of safety are a passing fad that can disappear at any moment. Apply these immortal principles to survive in the real market. You can discover more customized investment tools like 3D flashcards and mind maps at bookbriefing.com. Thank you.